Well, good afternoon, everybody, and welcome to our joint class and Heffron compliance webinar for the 2022 financial year. My name is Sebastien Brennan. I'm one of the consulting team leaders here at class. And I'm very pleased to welcome back Lynn Formica, who's the head of SMSF Technical and Education Services at Heffron. Lynn, I'm sure, is going to be someone that you're very familiar with from the many industry events that she often presents at, like the SMSF Association Conference and some of the Heffron branded events, like their upcoming super intensive day that they've got next month. So we're very grateful to have Lynn join us back again to come and share some of her thoughts on the topical areas that are likely to come up as you prepare your clients' work for the 2022 financial year. And I'm going to share some tips and insights onto how those areas relate in class. So we've got quite a lot of content to get through today. We do have Sean, who's joining us from Heffron, and Alexis from class, and they'll be here to answer questions throughout today's presentation. I do ask a small favour that you would use the Q&A box that's available at the bottom of your Zoom to pop your questions. Please just use the chat if you have any technical issues. Just in relation to any technical issues that you may encounter, we do encourage you to change the audio source if that's something you do encounter, or try and log out and log back into the Zoom. We will be recording today's webinar, and we will make sure that a copy of the recording, the presentation slide and the Q&A is made available to all the attendees, and we will also make it available on the class training and webinars tab. So I'd like to hand over to Lynn now to go through our first topic. Thank you, Lynn.
Thank you, Seb, and thank you everyone for joining us today. So yes, 21-22 year ends. It's time to get rolling on them. The first thing that I wanted to cover off on is in relation to the 22 SMSF annual return. So what changes are we going to see? For those of you who have already started processing 21-22 year end work, you'll have noticed that there are few and far changes. There's very few changes in the 22 SMSF annual return. Essentially, it's just allowing for the 6-member concept now. So we're allowed to have 6 existing members and 6 former or deceased members. So pretty much nothing else has changed. What I did want to remind you of, though, is in relation to COVID-19 recontributions. So this is the first year, 21-22 will be the first year that your client has potentially made a COVID-19 recontribution. So this was a new category of contribution that was introduced. We have all the same eligibility criteria for clients making a COVID-19 recontribution. It's just that if they satisfy other criteria, they're able to elect to have this amount not counted towards their non-concessional contribution cap. So they have to make an election filling out a form like you do for downsizer contributions or CGT cap contributions. So this is only for people who validly withdrew some of their superannuation benefits under the COVID-19 condition of release. So remember in 1920 and 20 and 21, some of our clients were eligible to take out 10,000 each in each of those years, and essentially were basically withdrawing their superannuation benefits early, but quite legally under those rules. A COVID-19 recontribution allows them to recontribute those amounts back into superannuation, and they have up until 2030 to do that. So COVID-19 recontributions will be around for a long time, or potentially around for a long time. They'll have to make an election to have it not counted towards their non-concessional contribution cap. There's no functionality for that on your 2022 SMSF annual return like there is for CGT cap contributions or downsizer contributions. So what you're going to need to do if your client has made one of these contributions, has made a valid election to have it not counted towards their non-concessional contribution cap, you're going to report it like any other personal contribution. And then you're going to need to lodge a CSV file with the ATO to report the information so the background the ATO can check and do what they need to do to make sure it's not going to count towards the non-concessional contributions cap. So Seb, I believe class can create the CSV file for us.
Yeah, so I'll just jump into class and take everyone through that. So in terms of where to record the event, it's going to be under the normal member income and member contributions field. So I've already processed one here, which I'm going to show you. The important thing to note is that if you are entering a contribution that's dated on or after the 1st of July 2021, then this field, which is the one that I'm about to highlight here, will now appear. So if it's dated before that, you won't see that field. On or after 1st of July 2021, that field will appear, and you're able to enter the amount of the recontribution for the member. What it will do, once you've submitted that event, you will notice there is a button at the bottom of the event. And this button here allows you to generate that CSV that Lynn was talking about. So if you do want to ensure that the contribution amount is not counted towards the member's non-concessional cap, then you do want to generate the CSV. So for many of you, you'd be familiar with the process in terms of generating a file for your TBAR, transfer balance account reporting. You generate a TBAR from class, you lodge it on the tax agent portal. It's very much the same process here. So you'll be able to generate the event from here. You won't be doing that in bulk. It is a event that's just going to be visible at the fund level. And that was the decision that was made, given that it's likely to be a relatively small number of funds that will have this type of event. So the second thing I want to just show you quickly is the update to the annual return that we've made. So as you can see here, we've now got 6 members that are visible in the annual return for the 2022 year. As Lynn said, you can have also an additional 6 deceased or former members that could show on here. And in relation to that recontribution amount, it is reported. You can see here for this particular member, class will automatically report it as a personal contribution. And then by lodging that CSV file that you've generated, you'll be telling the ATO not to count it for the member's non-concessional cap. So Lynn, I'll hand back over to you to take us through the next section.
Excellent, thank you, Seb. So yeah, so our next topic, potential pain points for our 21-22 year ends is in relation to SuperStream. So remember, of course, that since the first of, I'm just going to get this little slide to move along. There we go. So since the 1st of October 2021, we've got a little delay with our Wi-Fi, I think. So since the 1st of October 2021, let's get one. Oh, come on, computer, you can do it. Since the 1st of October 2021, you'll know it's been compulsory to use SuperStream for whenever we've got rollovers from APRA funds into our self-managed superannuation funds, whenever we're rolling monies from one self-managed superannuation fund to another, or where we've got a self-managed super fund that perhaps is winding up or exiting a member and they're rolling across to an APRA regulated fund. But we don't use SuperStream for in specie rollovers, so where we're transferring assets rather than cash, or when we're transferring monies between foreign superannuation funds. Whenever we've got those internal rollovers, so a contribution split or a family law split or something like that. So SuperStream is only for rollovers, basically from one fund to another that's in cash. So we can't go through all of the mechanics of SuperStream. We could spend a couple of hours talking through the issues in relation to SuperStream and how we use SuperStream. But what I want to walk you through is what auditors are going to be looking for and those sorts of things. But I wanted to just do a little quick poll first. To have a look to see who's been using SuperStream. So if we can just launch that poll, please. So basically, I'm curious as to who's used SuperStream to process just a rollover into a self-managed super fund. Maybe you've done a rollover out of a self-managed super fund using SuperStream, or maybe you've been fortunate enough to do rollovers in and out of self-managed super funds, or you might be one of these people who've not yet had the wonderful opportunity to use SuperStream for rollovers in or out. So hopefully we've got some answers coming through. Let's share the results. Yeah, so essentially a lot of people, so 54% of people have been doing it for both rollovers in and out of self-managed superannuation funds. 27% of you have not yet had that opportunity to utilize SuperStream. If we can just close that poll. Thank you for indulging me to get some of the feedback. For those of you who have used SuperStream for a rollover in or out since the 1st of October, it's really important to be aware of what your auditor is going to be looking for when they're auditing a 21-22 year end. So remember, if we think back pre-1st of October 2021, if we've got a rollover into a self-managed superannuation fund, historically the auditor would have been wanting a copy of the rollover benefit statement that would have been issued. And then they were just making sure that the preservation components had been correctly allocated inside the self-managed superannuation fund. Well, since the 1st of October 2021, it's a little bit different because we have the SuperStream rules. So essentially, the auditor is going to be looking to see how this rollover in was requested. So if the member had made their rollover in request directly to you as the administrator of the receiving self-managed superannuation fund, and you used the class software to initiate that rollover in, so it basically you had used your class software to trigger a communication through to the transferring fund to say, hey, my client would like to roll out of your fund and roll some monies across to me as the receiving self-managed super fund. If you've used that functionality, it's relatively uncommon because a lot of our clients go to MyGov, or they go to the fund they're currently a member of, the transferring fund, and request their rollover from there. But if we have had the members coming to us as the receiving SMSF and us triggering the rollover, then your auditor is going to want some confirmation to show that all happened through SuperStream. So maybe some screen dumps. They're potentially also going to want confirmation that rollover was allocated to your member account within 3 business days. So some auditors are satisfying themselves of that by just getting a declaration from the trustee. If it's a rollover out, and again, before the 1st of October 2021, again, looking for a copy of the rollover benefit statement. And then if that particular benefit included preserved or restricted components, then often they were wanting to make sure that the receiving fund did in fact receive those particular benefits, so that they could double check that the monies hadn't been lost from the superannuation system. They don't need to check for that anymore because of SuperStream, but essentially they will be looking for things like a signed rollover request from the member. If the member had made their request to rollover out directly to the transferring SMSF. If instead it had gone via MyGov or the receiving fund, then again, we're going to want some SuperStream confirmation, so some screen dumps to show that SuperStream was used for that. And then it doesn't matter how the rollover request was initiated, we will want to have some screen dumps or show the auditor some screen dumps to confirm that we did in fact use SuperStream to process that rollover and get the data across to the receiving fund, whether it was another self-managed super fund or an APRA regulated fund. Your auditor is also going to be wanting for confirmation that all of that happened no later than 3 business days after the transferring fund received the required information. And again, often they'll be asking your clients to complete a declaration to confirm that you complied with that 3 business day rule. Just remember as well that even though we don't give paper rollover benefit statements to superannuation funds anymore, we use SuperStream to send the data across, there is still a requirement to give a rollover benefit statement to the particular member. So even though you're using SuperStream to send the data across to the receiving fund, make sure you're still issuing a rollover benefit statement through to the member themselves. Now, there will be lots of us that have clients who don't comply with the SuperStream rules. SuperStream rules are relatively difficult to implement in their initial stages because there's a whole education process that needs to happen. And there's lots of things that can inadvertently go wrong. So just to give you some examples so that you don't panic if you have one of these. If the trustee facilitates this rollover by sending a paper rollover benefit statement and a check through to the receiving fund, well, of course, that's not complying with the SuperStream rules. Now, there are some exemptions available, but that's only if your client was having difficulty getting an electronic service address. Now, by being here today, I assume you're using Class, in which case you had ready access to an electronic service address. So none of your funds probably qualify for that exemption. But even the fact of making a single transfer of data to the receiving self-managed super fund, which is then made up of multiple payments, that doesn't comply with the SuperStream rules either, because SuperStream is about a single transfer of data matched off with a single payment. So, if you've got a client where you were trying to roll over $100,000 from Fund A to Fund B, and Fund A has a daily payment limit on their SMSF bank account, and instead of, you send a data transfer of $100,000 across to Fund B, but Fund A trustee says, well, I've got a daily payment limit, so I'm just going to send 2 payments of $50,000 to match off to that 100 grand. That's a breach of the rules. And in addition to being a breach of the rules, you're making it really, really difficult for that receiving self fund to match off that information, because they don't know to be looking for 2 payments. They're going to see $100,000 worth of data and a payment of 50 and it not matching off. Even taking longer than 3 business days to process the rollover is going to be a breach, because the law doesn't allow time for selling down of fund assets to make sure that we've got liquid assets to transfer, getting up-to-date valuations, calculating member balances. Our 3 business days starts kicking from the moment this particular member gives us enough information. And enough information is simply the details of the fund they're going to. So name, USI, ABN, address, and their member account number, and then the 3 business days starts ticking. So what do we do if we have a client who hasn't complied with the rules? Well, it is a breach of the payment standards. So your auditor will need to report that in a management letter through to the trustees, just like any other breach. If it's material, they will probably also do a Part B audit qualification. And if it meets the reporting criteria, then they would also lodge an auditor contravention report with the ATO. What could then be the implications for the trustee? Well, in theory, because it's a breach of the payment standards, so the operating provisions, it could be an administrative penalty on the trustees of $4,440 each. Given we're in the very early stages of a brand new process, I would expect the ATO would remit penalties when our clients are making genuine attempts to comply with the law. So I would just encourage you to encourage your auditors to explain any of those exceptional circumstances in your auditor contravention report, so that once that contravention report goes through, the auditor can, the ATO can look at that and go, nothing to see here. It's a, perfectly innocent mistake given the early stage of the process. Don't forget as well that SuperStream is not just about rollovers. So release authorities can also now be coming through via SuperStream. So this is where your clients have a Div 293 tax assessment, or they've had excess concessional contributions, excess non-concessional contributions, and they've made an election to have monies released from superannuation. Once they make that election, a release authority is issued through to the particular superannuation fund. Now, if you've got a self-managed super fund with a rollover compliant electronic service address, such as the class electronic service address, then the ATO will now be issuing release authorities to you via SuperStream. All you've got to then look after is making sure that the fund makes a payment through to the ATO within 10 business days. So SuperStream will give you the payment reference number and the amount, and you'll need to send that information to your client or whoever has authority on the bank account to make that payment. And then you'll need in your SuperStream dashboard to click through to show that that payment has been made to the ATO. If you've got self-managed super funds that don't have rollover compliant electronic service addresses, well, we just continue with the old paper forms. So essentially, you'll still need to fill out that release authority statement and send it back, as well as making the payment through to the ATO within that 10 business days. So Seb, are you able to show us through class in terms of rollovers in, rollovers out, release authorities, those sorts of things?
Absolutely. I'll just start by saying that, look, as you mentioned, there is still quite a lot of an education and I guess people getting used to the new process. We won't have time to cover off everything today, so I'm going to focus on the parts that you mentioned today, but we will be organising a dedicated SuperStream webinar next month, which we will share details about in the next few weeks. So I just want to touch on the evidence that you can provide for your auditor once that rollover release authority has occurred. So for those who are not familiar with the rollover and release authority processing class, there is a new console that's available at the business level. And if you select that console, you may notice that the default filter is selecting the current financial year. So given that we're working through the previous financial year, I want to make sure that everything is come across correctly. You can select that filter. You can also select all data. So the first thing that I would recommend that you do is use the status filter, and we're going to look at rollover in first. So I'm going to look at the unmatched rollover in. Now, these are requests that have come in and the payment has been made by the other fund. We need to confirm that payment has been received. And so there is actually an action that's required on your side as the class administrator. What you need to do is go into the match transaction screen. You should see the cash event. Hopefully, if you've got a data feed set up, see the cash event. You'll see the business event, which has been created automatically by the SuperStream message, and you just need to match them off. So once you have matched them off, you need to come into here and confirm that that rollover has been correctly made. So if you're providing this particular piece of evidence to your auditor, let's say the payment has been received, but you forgot to come in and match it off, then the status is still going to show as unmatched. So the auditor is going to be focusing on the status being complete to know that that has been successfully actioned through the SuperStream messaging. If for whatever reason you need to reject that rollover, you have the option to reject it here, and you can specify your reason. So the first action that I would encourage you to do is to look at all the unmatched statuses you have for the 22 financial year. You should by now have matched all of those off. If you don't have a particular data feed for a fund, it's a good idea to reach out to the trustees and confirm that payment is made and get the bank transaction so you can match it off. In terms of the matched payments, so if we go to the complete status for rollover in, this is the message that you should be looking for that will confirm that the SuperStream message has reached the end, that the payment has matched off, and then you are able to export this as a PDF. And that's what you can use for your work papers. So it's probably a little bit small for you, but effectively the information that's captured on here is the details of the balance and the fund that made the transfer. We have had some questions from people about wanting to see potentially information about preservation and tax components. And as Lynn mentioned, you can still obtain a copy of the rollover benefit statement from the transferring fund. It is actually available as well in the messaging. So if you do want to confirm those amounts, you are able to see that in the fund that has received the rollover. So if I take a look at a particular fund and we look at browse events, if we look at a rollover in transaction that's come through, you'll notice here I'm able to see the details of the preservation and tax component. So if you do want to see that, that is still visible within class. So with a rollover out, similar sort of process, but for those of you who are not familiar, let's take a look again at how to action that. So again, it's back at the business level, rollover and release authorities. So this time I'm going to look at the rollover out pending. Rollover out request received. So this is where another fund or the member may have gone on to the MyGov to request a rollover, and the fund that's on class has received their SuperStream message. Now, what is required? Again, there is action required by the administrator. You need to provide these details, and you can provide it as a PDF to your trustees. It does include details of the payment amount. It includes the payment reference number, and it's important that payment reference number is used when the payment is made. As Lynn mentioned, if there is a need to split the rollover into multiple rollovers because of the limits on internet banking transfer, then you should do that in terms of the rollover request. The other thing that's important to note here is that the process on Class when it comes to rollover hasn't changed. So we do require you for a significant balance, or where the amount is a full amount that's been rolled out, a period update should be done the day before. Now, it's very important that you make sure that the period update is done, the payment is made the very next day. If you are waiting a period of time, then potentially the actual amount will be different, and that can cause issues down the track, particularly if you end up rolling out more than the balance would have been. Now, we often get questions, what is a significant amount? What I would say is if you're in doubt, there's no harm in doing a period update the day before. Clearly, if it's a very small amount, $10, $100, then it's probably not going to be required. But if you are in doubt, best to go and process that period update. Just make sure that the trustees know that they do need to make that payment the very next day. If they don't, then you're going to need to run the period update again and confirm what the balance should be to make that payment. So you'll notice on here the details of where to make that payment will appear, and you're able to provide that to your trustees. Now, back at the top, remember there was an action that you need to take here. You do need to confirm that payment. So once the payment has been made, ideally if you've got a data feed coming through on Class, you're going to see that appear the next day, and you're going to be able to match that off with a business event and confirm the payment. And again, if you, for whatever reason, need to cancel that rollover, you're able to cancel that rollover through here. So just make sure that you are actioning all of the particular request to receive status for rollover out. Now, the status that you should end up with at the end is the complete status again. So same as the rollover in, you are also able to export your screen dump, which confirms that the rollover was done via SuperStream. Now, we also have in the past had questions about the rollover benefit statement. You are still able to generate that from Class. So again, if I go back to my fund and I take a look at transactions, browse events, and I look at a rollover out that has been matched off to cash. So for those of you who have used Class prior to SuperStream being implemented, you would know this particular event would look quite familiar. It's the same event as we had in the past. So you've got the information, though, has been pre-filled by SuperStream. So you don't need to go in here and add any of this information anymore. All this information is updated automatically. And notice at the bottom, you have the option of generating a rollover benefit statement. So you can still generate that and provide that to your members. The final one is your release authority. So the release authorities, the process is very similar to what it is for a rollover in, a rollover out. So if we go back to that console and take a look at, again, 2022 financial year. So we've got, first of all, the request received status. So this means that you have received a request from the ATO that you need to action. So again, given that we're now at the end of August, I would highly recommend that you review your console to make sure that you don't have any outstanding requests relating to the 2022 financial year. Again, on Class, you are required to take action. The action is the same as for rollover out. You need to confirm once the payment has been made. You need to make sure that the payment reference number is used and that you've got the bank details provided at the bottom. Again, with a release authority, it's probably unlikely that the balance is going to be significant, but if you are in doubt, you can go and run a period update, and that will make sure that that amount is confirmed. So that's the core information in terms of the SuperStream. There is a final point. If you're unsure or worried about not receiving notifications, particularly for requests from via release authority, for example, or from another fund, you are able to configure your notifications here. So what we'd encourage you to do, if you haven't already, is to go to your business level settings, look at your notifications, and just make sure that you have updated your notifications for SuperStream and that you've updated which particular contact should be receiving a message for any that come through the SuperStream console. So Lynn, I might hand back over to you, and we'll go through the next section.
Yeah, so thank you, Seb. Really valuable information. There's a lot to understand there and unpack, but really important that we do that. As Seb's saying, this system isn't going to work unless we're matching off those transactions, confirming that we've made payments, confirming that we've received amounts, those sorts of things, because otherwise the right notifications aren't going back to the respective funds and to the ATO as well. So the next area that I wanted to cover off on is in relation to market valuation requirements. So, these rules haven't changed, but they do seem to still be causing us grief. And often it can hold up the whole process if we have an auditor who's waiting for market valuation type of information and it's holding up the lodgement of returns and those sorts of things. So I just wanted to do another reminder of what is needed and what you need to be looking out for. So just to recap, what is necessary from the market valuation requirements. So trustees have an obligation to make sure the SMSF assets are valued at market value in the fund's financial statements, because SIS Regs 8.02b says that we should have to do that. And also when we're commencing pensions, because it's part of the ATO valuation guidelines to make sure that we're not understating the value of pensions for transfer balance cap purposes. So trustees have an obligation to make sure we've done those, we've valued our assets at market value, and they also have an obligation to provide objective and supportable evidence through to the auditor. So the auditors aren't required to value the assets, they're required to review the evidence that the trustee has supplied and form an opinion as to whether it's suitable evidence or not. And often trustees are a bit confused as to why we have these requirements. So it's sort of multiple faceted. It's part of prudential rules. So it's part of our covenants in the sense that we're required to make sure, SMSF trustees are required to make sure that they're managing the members' money in the best financial interests of the members. And so the best way to do that is making sure that we've got up-to-date valuations of fund assets so we can provide more meaningful information through to our members about our particular fund's investment performance and be able to compare it to different investment strategies, different superannuation funds altogether. But of course, there's also another side to that in terms of allowing the ATO assess compliance with particular things. So SIS rules, things like the in-house asset rules, because they're based on us making sure that no more than 5% of the fund's assets are invested in in-house assets. And that's on a market value purpose. Our minimum pension rules, if we've got clients who are in pension phase, we're required to pay withdraw at least a minimum amount each year. Again, those minimum pension calculations are based on the market value of the fund's balance. And it's really also important around any tax concessions that your client might be utilising that are based on total superannuation balances. So if you've got clients who are utilising their carry forward concessional contribution cap space, or they're making non-concessional contributions, even potentially using the bring forward rules as part of non-concessional contributions. Even the methods that we use to claim our exempt income, those sorts of things, all based on total superannuation balances. And you'll find that if we're not revaluing our assets to market, perhaps our assets are understated, then we might be thinking our client's eligible for a tax concession that they're in fact not eligible for. Similarly, when we're commencing pensions, as I said before, making sure that we've valued our assets to market before that pension commences, or before we've got a TRIS that becomes a retirement phase pension, so that we can make sure the amounts that have been tested against the transfer balance cap are not understated. So that's not to say that if I've got a 35-year-old only member of the fund, they're not making non-concessional contributions. They don't have any in-house assets. They're obviously not in pension phase. They're not making concessional contributions in excess of the standard caps, those sorts of things. It's not to say you can go, you know what, I'm not going to worry about the market valuation requirements, but certainly they're not a huge risk area for that style of client. Our risk area in relation to market valuations are our funds with in-house assets, our funds paying pensions, our clients doing non-concessional contributions or utilizing their carry forward concessional contribution space. So they're the ones that they're the client group that I should be paying greatest attention to. Obviously, I still need to make sure all of my funds are valuing their assets to market, but the risk, that the possible implications are a lot lower for other types of funds. So, what is sufficient evidence? So the ATO does have valuation guidelines for SMSF. So if you just Google ATO valuation guidelines, SMSFs, you get a really detailed explanation of what the ATO thinks is suitable evidence for various different asset classes at various different occasions. Real property is one of those. So I've given you a list there of what the ATO would consider to be sufficient evidence. So, gold standard at the top, getting an independent professional paid for valuation. But you don't have to have that. So, a curbside appraisal from a real estate agent would also be an item of evidence. If I've got information from a property valuation website, such as RP Data, CoreLogic, those sorts of things, so long as that information's showing me a high confidence factor, then that should be sufficient evidence. Just remember, though, that we need 2 items of evidence, or in the ATO's view, we should be getting 2 items of evidence. And also making sure that looking at the timing of that, because, if we're downloading information from RP Data, for example, then a download in July is giving me a July valuation of that asset. I wait until March 2023 to do an RP Data download. I'm getting a March 2023 valuation, which could be quite different to a 30 June valuation. So if you're using things like RP Data and that sort of stuff, run your reports now if you haven't already to start getting that evidence. Alternatively, you might not be able to use your RP Data reports in March next year because they might just be too old. In that situation, you're going to have to get the client to, go to the estate agent and not ask for a current valuation. Ask them for, can you give me a valuation of what the asset would have been worth back on 30 June 2022? So if I just give you an example of what 2 items of evidence could look like, I've got Ali. She's got a self-managed superannuation fund. Her fund owns some residential property, bought a number of years ago, and we've got no recent renovations to it. She goes off and gets a curbside appraisal from her local estate agent, and that appraisal includes comparable sales results of similar properties. Is that one letter that I've gotten from the agent sufficient evidence? And yes, that actually counts as 2 items of evidence, because I've got an appraisal from the real estate agent, and it would have said, I believe the property is worth between X and X, and it then would have listed out the comparable sales data on which that valuation was based. So that is 2 items of evidence and sufficient from the ATO's purposes. Just because it's on one piece of paper, don't look at it and think, that's only 1 item of evidence and I've got to go and find something else as well. So just give you some example of some multiples, some 2s. So an RP Data report where we've got a high confidence factor. Those RP Data reports, they're going to include comparable sales data. So they're going to count as 2 items of evidence. Alternatively, maybe your RP Data report's actually got a low confidence factor. That doesn't mean I can't use it at all. It just means that I need another item of evidence to go with that. So perhaps if your client was able to do some online data checking to see if they could find some comparable sales results, more current, more reliable comparable sales results, that can then match together with the RP Data report and count as 2 items of evidence. If you've got vacant land, then have a check with your auditor, but your 2 items of evidence could be a rates notice, showing obviously the unimproved value of that land, as well as perhaps say a curbside appraisal without any comparable sales data. So just making sure that you're having conversations with your auditor to know exactly what they're looking for. If it's commercial property, then it might be slightly different. Your auditor might have slightly different, guidelines. Often they will want, an independent valuation, a paid-for valuation every few years, and then some other less reliable, if I could put it that way, less expensive evidence in the meantime. So perhaps an appraisal or some Google searching on, what the trustee feels that asset might be worth. If it's unlisted shares, unlisted units, that's usually our other problem area. ATO's opinion, sufficient evidence would be, if you've been very fortunate that there's been an equity raising in the last 12 months and it's been unrelated parties who've been participating in the equity raising, well, that's fantastic. So if the share registry of the company, or if it's who's looking after the share registry, can provide you with that information, well, that would be fantastic. Similarly, if we've had units or shares which have been sold to unrelated parties in the last 12 months, that'll give us a great indication of value. If you're fortunate enough to get a director or a CFO valuation, just make sure that they have information there to say how they derived that. So you just need that little explanation of what they based their valuation on. We don't need all of the information underneath, but just a summary of how they determined what they think the assets, what the shares or the units are currently worth. It's not enough, net tangible assets of a company as per the financials are not going to be sufficient for audit purposes if those assets are recorded at cost in those financial statements. So just have a review of the notes to the accounts to see what the accounting policy there is. If they're doing it on cost, then that's not going to be sufficient evidence. We would have to have, we can only use those financial statements if they were based on market value. Sometimes our clients invest in these unlisted shares, unlisted units, and they go belly up, or they look like they've gone belly up. We get a situation where the trustee's doing everything they can to get information about this particular entity, and they're just not responding. That the person they're usually dealing with is just not responding, and there's every indication that this particular entity has presumably folded, but they can't get any information from that. ATO would say in that situation that we should record that asset at a zero or a nominal value in that situation. We can't write it off for cost-based purposes because we don't have a liquidator's determination or those sorts of things. But I think from a market value accounting point of view, it would be quite appropriate to take that back down to nil. On that side of things then, Seb, have you got some information that you'd like to show us?
Yeah, just a couple of things very quickly. So I just wanted to bring up, first of all, the investment revaluation report. I'm sure many of you are very familiar with this report, but if you are not, it is a good report to review once you've completed your fund for the year. So what you're looking at here in particular is for all of your investments that are listed, whether that be foreign or domestic investments, often the price will come through automatically on Class. And this report allows you to check when that price last updated on the Class system. And so obviously those that are priced around 30 June are what we would expect to see, but you might see somewhere for a particular reason, the last price actually came through earlier on in the year. And it might be because it's now become unlisted or something has happened. So it's a good report to review as you get to year end as a starting point to see, which investments might I need to do a bit of a follow-up in terms of getting that valuation. Obviously, things like property as well. In this case, you can see it hasn't yet been revalued. So it gives us an indication that we need to go and follow that up. Now, in relation to the property valuation, as Lynn mentioned, it's important that we consider on or around this time of year to be getting those valuations or to be requesting at least trustees to go and obtain those valuations. So on Class, you do have at the business level a property console. So if you go to investments, go to property consoles, you can see a list of all the funds that hold property, and you actually see each of the property on here. Obviously, in this case, not many properties held in this particular demo business, but the actions at the top are actually telling you the status of the valuation for the particular financial year. So if you select that financial year filter, you can see I've already requested the valuation for my one property. But if I had other properties that I had not yet requested a valuation, I would see them in red. And those that are in progress, I would see in orange. So it's a good idea. If you haven't yet done that, maybe post this webinar, go and look at your property console, see if there's any properties that you still need to request a valuation for, and maybe set that in progress so that when you come to processing the financials, it might be in March or April next year, you've already got that valuation you obtained earlier on in the year. Now, of course, Class does offer a free automated valuation from RP Data for residential property. It's not available for a commercial property because it's not as easy to value that property based on similar sales within a particular suburb. So what I'd recommend you do, first of all, is if you've got residential properties, make sure you update the details in terms of the title reference for that particular property. I'll just take a step back and show you that under the property. So if you go to fund level property and you look at the property details, this is where you're able to update the address and verify it with RP Data. So that's required if you've got a residential property. Once you've done that, you can request that valuation and you can do that once a year. So if we look at property valuation here, I've already requested an RP Data valuation. If you had decided to use a different valuation source, or you've requested the RP Data valuation, but you want to update the valuation because of additional evidence, you're still able to come into here, update that valuation, and you can add any notes that you require. Now, just for those of you who may not have looked at a particular RP Data valuation, as Lynn mentioned, you'll have an estimated price range, forecast standard deviation that's updated at the top, and then you'll have similar sales for properties within the area for a particular time period. So that's one example of one of the integrations that's available within Class. So Lynn, I'll hand back to you to take us through the next section.
Excellent, thank you, Seb. So the next area I wanted to go through was in relation to exempt current pension income. So I know Class has already had a webinar recently in relation to the exempt current pension income changes, but I just wanted to walk you through now how we can quickly identify the type of client that might have been impacted by these changes. So the first change was really simple. This basically affected funds where 100% of the fund's assets are supporting account-based pensions or market-linked pensions all year. And quite a simple change, just basically saying that these particular funds no longer require an actuarial certificate to claim exempt income, regardless of the size of the fund, because you may recall 2021 and earlier years, if we had a member of that fund who had a total superannuation balance of more than 1.6, essentially we still needed to get an actuarial certificate for that particular fund. We weren't permitted to use the segregated method, even though the whole fund was entirely in pension phase. We were basically using the actuarial certificate method. Of course, that certificate would have said 100%, but without that certificate, we weren't entitled to claim any exempt income. So that particular rule has been removed. So for our 21-22 year ends, doesn't matter the size of the fund, if the whole fund is in pension phase, account-based pensions, market-linked pensions for the entirety of the year, then basically we're 100% tax exempt without the need for a certificate. The second change is a little bit more complicated. So this is basically impacting funds where, whilst the fund may not have been entirely in pension phase all year, it was 100% in pension phase for some parts of the year. So we had some parts of the year where our assets were solely supporting account-based pensions or market-linked pensions. We had other parts of the year where we had basically a mix of pension and accumulation phase. In that situation, we have to check the size of our fund. If on that previous 30 June, all members of our self-managed super fund had a total superannuation balance of less than 1.6, then we're in a situation now where we actually have two options for the way that we're going to calculate our exempt income inside those funds. The default is basically to do what we have been doing for the last few years, which is basically saying that we have to use the segregated method for those parts of the year where we're entirely in pension phase and we get 100% tax exemption on the income that came in those particular periods. But we have to get an actuarial certificate if we want to claim exempt income, and then on the income on any of those other parts of the year where we had a mix of pension and accumulation. But we now also have the option to make a choice and say, you know what, I don't want to use those rules. I don't want to use the default. I'm going to get an actuarial certificate and use that method for the entirety of the financial year. So for those of you who have been in SMSF land since before 30 June 2017, this is taking us back to old school rules. This is what we used to do prior to 30 June 2017. I'm showing my age, aren't I, Seb? But essentially, we basically would go off and get an actuarial certificate and apply it to our income for the entirety of the year. So we now get the ability to pick and choose. If we don't make a choice, then we're using the default method, which basically requires us to use the two methods in one. So let's just look at some examples of the types of funds, types of scenarios that you're looking for. So you're looking for funds, say, where the fund was entirely in pension phase for most of the year, but then perhaps a contribution came in towards the end, and that particular person couldn't get it across to pension phase because it would have exceeded their transfer balance cap. Or perhaps we've got a fund where they didn't conveniently retire on the 1st of July. So they were in accumulation phase or perhaps a TRIS up until a particular point, and then retirement phase pensions commenced, and the entire fund then ended up in pension phase from that date onwards. Or it might be that we're winding up the self-managed superannuation funds. So we were entirely in pension phase for a period, we commuted all of those pensions, and then we were basically had a little accumulation balance for a period of time until we wound up that fund. Or the third option is probably the least rare of the lot of them. This is usually when we've got a financial planner who's involved. So this is usually a situation where we're entirely in pension phase, then we've got a contribution come in, so we've got a mix of pension and accumulation, and then the advisor's done another statement of advice and we've sent that contribution to pension phase, so we're back being entirely in pension phase. So they're the sorts of scenarios that you're looking for or need to go, oh, I think I've got one of these funds, or I'm allowed to use, I'm allowed to make a choice. So how do I know? Well, it's really important to understand what the two choices mean. So if I'm using the default option, I'm using both of these methods in the same year. So remember, segregated method, all of my income is tax exempt in that particular period. If I happen to make a capital gain or crystallize a capital loss, I ignore it in that particular period. Whereas if I'm using actuarial certificate method, then a proportion of my income is tax exempt in that particular period based on my actuarial certificate. And if I happen to end up in a net capital loss position, that's going to carry forward to future years. So if I've got a fund and I'm using the default option, I'm using both of these methods at different stages within our financial year. Alternatively, I make a choice and I just use the actuarial certificate method for the entirety of the year. So sometimes it'll be really obvious, you know, if I've got this fund where I was entirely in pension phase for most of the year, and then I was sitting there with a mix of pension and accumulation towards the end. You know, if most of my income was derived whilst I was entirely in pension phase, so that green part of the year, I'll probably use segregated method, because then all of that income that came in that green part of the year is completely tax exempt. Whereas I might choose the opposite if, for example, the majority of my income for the year was in fact maybe a large trust distribution that came in June. So it came in that blue bit where I was a mix of pension and accumulation. In that situation, if I use segregated method, I'm probably going to have a worse off position. I'd be better off making a choice, getting the actuarial certificate for the entirety of, or applying it to the income for the entirety of the year and getting a higher proportion tax exempt. Or if it's one of these funds where I was in accumulation phase for part of the year and then completely switched across to pension phase, it'll depend on what sort of income I earned. So for example, if this particular fund had made a capital gain whilst I was entirely in pension phase, I want to use segregated method because I want that gain to be completely tax exempt. I don't want to be in a position where I'm getting an actuarial certificate and applying a percentage to that income, because then only a portion of it would be tax exempt. And that's really important if I had carry forward capital losses, because if I'm going to use actuarial certificate method, that gain I made in pension phase will use up my carry forward capital losses. So just watching your methods and making sure you understand what happens to capital gains and capital losses in those various parts of the year. You know, if it's not obvious, then just run a period update twice. Basically order a draft actuarial certificate for both of the options. You know, if you order your certificate through Heffron, we will only charge you for one certificate, but you get the flexibility to run the calculations twice so you can see what the tax result is. Just really important that you don't just look at the end income tax position, look to see what it did to your capital losses. You don't want a situation where you look at it and think, oh, not much tax difference. I might just, go particular method. And you've got $500,000 worth of capital losses that got eaten up because of the method that you chose. So make sure you look at the capital losses as well. Seb, I don't think there was anything there that you wanted to show, given you'd done that entire webinar on eCPI, or did you have something there?
I might just show something very quickly. I'll try to keep it on time. So the first thing to say is that we do recommend that you start a new fund policy at the start of each year. So you need to go to the settings at the fund level and fund defaults. And from here, you will have the option to start a new fund policy. So recommend you do that each year, even if the fund policy is remaining the same. The other thing to note is we do have a new field that will appear on some of your funds. I say some of your funds because it will only show if Class thinks that you're eligible. So that's this particular field here, election of eCPI calculation method. There are three options. There's a blank, there's the both proportion segregated method, and there's the proportionate method that you can select. So you do need to go and select one of these before you start working on your fund. If you haven't selected an option, you'll get a reminder when you run through a period update. In terms of which funds will show this particular field, Class will look to see if, first of all, there's a period where, say, 100% of the assets are supporting retirement phase interest, and then there's a period of accumulation. So we'll look at that. And the second thing it will look at is whether the fund is a disregarded small fund. So if the total super balance as at 30 June of the previous year for members is below 1.6 million, and it is very important that you do update that in Class. So what we would recommend you do is to tag your funds, particularly with funds where you know that a member's got an external super fund. And that way, what you can then do is go to your members console. You can show the tag for external super. You can select your financial year, and then you're able to go and update your members' total super balance under the contribution cap screen. So I'll just show you very quickly where that is. So if you go to contribution cap screen, this is at a fund level. You select the financial year, select the member, and then if you go and edit that, you have the option of putting the external accumulation phase balance or external retirement phase balance in here. Now, you don't need to have multiple fund policies. You can just have the one fund policy throughout the whole year. In terms of period updates, if you do change the fund policy or the actuarial certificate, once you've obtained the actual certificate, you only need to roll back the last period update. You don't need to roll back multiple. Just in the interest of time, I'll just show you as well very quickly for the next part that Lynn is going to cover on contribution caps. In this same screen, the contribution cap screen, you are able to add any external contribution that is made for a member to another fund. So that's for concessional and non-concessional. And that's important for both the bring forward rule and the catch-up contribution. So that's important to look at and update each year here. And you'll notice the class has updated the caps for the next financial year. So Lynn, I'll hand back over to you for the last few moments.
Thank you, Seb. Yeah, so the last thing we were just going to finish off on was in relation to contributions, just to make sure everyone has in their mind exactly what applies in which particular financial year. So we've had a number of changes, and some of us might still be processing our 2021 year ends. So remember, in that particular year, work test was a condition of eligibility, so trustees weren't permitted to accept a contribution from age 67 to 75 unless that particular person had first met the work test. And we had downsized contributions being eligible from age 67 and being able to trigger bring forward mode when we were turning 67 in a particular year. The year we've just finished off, 21-22, you'll be starting to process those particular ones. Essentially, nothing had changed other than the contribution caps, which Seb was just showing you where you could see those caps. So basically, they're obviously all updated in class. You just need to make sure that you've updated where contributions have gone into external superannuation funds. For the current year, essentially our 22-23, that's where we had those changes. So remember, the work test from the 1st of July 2022 onwards, work test is no longer a condition of eligibility to have a superannuation contribution made. Work test only comes into play where a person makes their own contribution to superannuation. They want to personally claim a tax deduction for that, and they're between 67 and 75. Our downsizer contribution age has dropped to age 60. And in fact, there's a bill before Parliament at the moment, which if it gets passed, will drop the downsizer eligibility age to age 55. It will start from the first day of the quarter after it receives royal assent. So if royal assent is granted before the 1st of October, the start date of that age 55 will be the 1st of October. If it doesn't receive royal assent until the 1st of January, the start date would be the 1st of January. And our course, our trigger age for bring forward mode for non-concessional contributions, our last opportunity to do that is now 75. So they're all the things that impacted from the 1st of July 2022. So we have run out of time. Thank you to Sean and Alexis, who I know has been madly answering all of your questions. Thank you for asking all of those questions. We don't have time, I don't think, Seb, to do a bit of a summary of the questions.
No, I think in interest of time, we might just end it there. We will share, obviously, a copy of all the Q&A shortly. So just keep an eye out for all the attendees. We'll be sharing a copy of those questions and answers